You've probably heard economics referred to as the dismal science. It's also widely said that you can make the numbers say whatever you want. Still, in policy, in elections, in everyday life, what the numbers say has consequences. Whether it's GDP or employment rates or inflation or what have you, economists weigh in, policymakers act, and the rest of us wonder what's what. So, how about we ask some economists to tell us, what do those statistics actually mean? Let's get into this. In the nation's capital, there's Armine Yalnizyan, economist, Atkinson Fellow on the Future of Workers, with the world's best record collection in the background. Also, Trevin Stratton, national leader and partner, economic advisory at Deloitte Canada. And back here in our studio, Benjamin Tal, deputy chief economist at CIBC World Markets, and Kaylee Thiessen, economist and policy analyst at Unifor, Canada's largest private sector union. And here's where we do the full disclosure thing. Some of the people working on this program, Kaylee, are in the same union as you. People taking our pictures, the people in the control room. So we put that out there in the interest of full disclosure. Great to see you two again. And to our friends in Ottawa, we're glad you could spare some time for us on TVO tonight as well. I want to start by showing two charts, and then we're going to have some discussion about it, because these charts purport to talk about the same thing, but they actually show pretty different results. And this is what we need to get our heads around. Let's start with whether wages are stagnant or robust. And for those listening on podcast, I'm going to just describe the chart we're seeing here a little bit. This is a graph. It's a line graph from the years 2013 to now. It's about wages and costs, and it looks at a number of factors, wages, labor force survey, accounts, payrolls, hours, productivity, and so on. And what we see in this chart, that with the exception of a big blip when COVID started, up, and then a big blip down as we got about a year into COVID, it's a pretty flat line. Wages basically haven't done anything for the last decade. But then we saw this tweet from the University of Waterloo economist Mikhail Skutterud, who said the following: claim was real hourly wage growth has been stagnant. His chart shows 22% growth over 23 years. That's a 0.9% annual growth rate over 23 years. Real GDP per capita grew by 27% over same period. And he concludes, I don't think this is what people have in mind when they hear stagnant. And this graph shows the same line, but it's not flat. It looks more, it looks like a kind of a short mountain, but it's going up from sort of bottom to top. It suggests wages are certainly more robust than the previous chart. And again, this chart goes back to 1998 to present day. So it goes further back and it shows a longer period of time. So we ask ourselves, what does all this mean? Who's right? Armine, start us off.
Oh, okay. First things first, wages were stagnant for about 20 years in the wake of the 81-82 recession and the 90-91 recession, almost zero wage growth. The first chart you showed roughly 3% wage growth every year, roughly, until the pandemic hit. And that chart comes from the Bank of Canada, which is really worried about wage price spirals taking off. In other words, people trying to catch up their wages to higher prices, which is the first time we've seen it since the 1980s. And we're not seeing any evidence as yet that wages are starting to spike in their pace of growth. Mikhail Skutterud's chart starts in 1998. That's roughly when wage stagnation ended. And he is right. It's the same as the previous chart, which the Bank of Canada was just measuring annual growth, year over year growth every year, and it didn't really budge. But he is also right. Every year, if wages grow about 3%, on average, then you are going to see a fairly interesting growth over time. You have to compare that, of course, to inflation. And you also have to take a look at whose wages are growing over time. And I guess that's the end of what I have to contribute in this opening, Wally.
Okay. Trevin, pick that up if you will, because I appreciate Armine says basically the graphs say the same thing. But I look at one graph and it's a pretty flat line, and I look at the other graph and it looks like a ski hill. So how can they be saying the same thing?
Yeah, I would agree, is that both graphs generally show the same thing. So even though in the first graph, the line may look flat, it's actually above zero. And so it's showing the growth rate each year being around 2 to 3%, meaning that wages are growing each year at a relatively consistent rate before the pandemic. Now, what we've seen since the pandemic, particularly in the last couple of years, is that even though wages themselves have been increasing still, they haven't been able to keep pace with inflation and price increases. So wages are going up, but you can't buy what you used to be able to buy for that price. And probably where a number of economists would disagree is what happens from here, whether we go to that pre-pandemic trend or whether things have changed going forward.
Okay. Benjamin, you've seen the two graphs. What do you pull from this?
Yes, so let me share with you some trade secrets. When you want to focus on something, you lower the scale, and the scale is very narrow, and then all of a sudden you see this mountain, and vice versa. You can zoom out, and then you don't see a flat. Those two charts basically telling you exactly the same thing.
But they don't look anything alike.
I know, and that's why you have to pay attention what it is. One of them is year-over-year rate of change. The rate of change. The other one is the level. The rate of change, as long as it is higher than zero, the level goes up. So focus on what they are giving you, year-over-year change or the level. It's basically the same chart, the same information. Extremely important, and what's not in this chart, is who is getting this increase in wages or not. And we have to remember that this is average wage. Now, an advice, the minute you hear the word average, be careful. Because average is very confusing, because it's a composition of labor as well. If you have less people working in low-paying industries, as we have seen during the pandemic, actually the average wage is going up because you remove low wage, low productivity people from the equation. All of a sudden, we are more productive during the pandemic. No, we are not. But because of the fact that, unfortunately, most of the people that lost their jobs were low productivity, low wage, all of a sudden the stock was actually high wage, high productivity. Be careful here. You have to look at the composition. And then, okay, who is getting the increase? Low wage, high wage, the average is very misleading.
We really have to drill down deeper to that next level down to really understand what's going on here then.
And that's why there's no clear, simple answer. The chart tells you only part of the story.
Okay. Kaylee, you weigh in. What do you see?
I mean, I think we're all in agreement on this one in terms of what these two charts are saying. One thing I think I would add in terms of what's missing is not only who's getting the raises and who's not, which is really important. Another piece of this puzzle is how many hours are we working? So this shows an hourly wage. Your income may have gone up or down based on how many hours you're working as well. And if you need more hours and higher wages in order to pay your bills, and you're getting perhaps the same wage and lower hours, that affects your ability to pay as well.
Mm-hmm. Okay, Armin, let me follow up with you then. If Jeff Bezos, during the spike of the pandemic, made a fortune, and a lot of lower-paid workers got laid off, but the average shows, therefore, that everybody's wages went up 3%. I guess that's clearly part of what's misleading about these statistics. Is that fair to say?
Ding, 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 winner, gagnant. You actually got it right.
Okay. Well, there's a first for everything on this program, okay? All right. So what do we do with that? If you're a policymaker and you want to be able to make policy based on what these charts are showing, and they look very different, but they're essentially saying the same thing, what do we do with that information?
I think right now we are just tracking to see how tight labor markets, the tightest in half a century, are translating to wage growth. And what those charts show us is nothing big is happening as yet, but we obviously want to keep our eye on this because nobody wants that dreaded wage price spiral that the Bank of Canada is so worried about. Frankly, we're paying the price for that before we're even seeing it, which is why it's problematic for me to watch wages grow at the same pace they've been growing for basically the last 20 years, not much changing, notwithstanding the fact that we're at 50-year lows in unemployment, and then say, we want to cool the economy because we don't want wages to go up. Seems brutal, actually, in an era of inflation that is faster than anything we've seen in 40 years.
Trevin, would you agree with that assessment?
Well, certainly, we've seen some changes during the pandemic when it comes to wages. At the beginning of the pandemic, we obviously saw wages go up, and that was partially because a number of people that were in lower wage occupations left the labor force. And as Ben was talking about, that's kind of skewed some of the data. What we've seen kind of happening since then is that we've actually seen wages start to go up quite a bit since around 2021 going forward. One of the big questions, of course, happening is what happens now because compared to inflation, wages have not been keeping pace. And so going forward, this is going to be a big question, of course, is whether we actually are able to go back to our pre-pandemic trend, or whether going forward, if there's a decoupling of wages and productivity, where we saw them much in line before the pandemic, and whether that changes going forward.
Okay, let's see if we can figure that out. Sheldon, if you would, can you bring that first graph up again? The one on page 1, which is a pretty flat line at wage increases going up about 3%. And then there's that big, okay, again, for people listening on podcasts, there's the big spike after COVID hit where wages go up more than 20%. But then, Kaylee, I see in the following year, they drop 10%. So people basically gave back almost half of what they got. So are wages, in fact, inexorably going up in a way that we would want to see, or no?
Well, so the chart is showing, the dip there is showing when people started being hired back after they'd been laid off for the lockdowns. So if we're thinking about people with lower wage jobs being hired back, that means the average wage is going down, not because people were taking lower wages, but because lower wage workers were going back into the labor market. This is an anomaly that we're going to be talking about for the rest of history when it comes to talking about wages and labor markets and what's going on. There's always going to be a circle around that. One thing that we have seen, though, is that wages are going up. Like Trevin was saying, they went up about 5.1% year over year in December. Part of that is the result of people bargaining higher wages, and part of that is the result of people actually moving to higher wage jobs. So during the pandemic, we saw some people lose their jobs, say in hospitality, and take a job in a higher wage job, and then realize that perhaps they like that job a little bit better. It's more stable. They have a better schedule for their family, and so they stayed there. Part of the increase then is moving from a lower wage industry to a higher wage industry, and some is people with lower wages coming back into the market.
But Benjamin, when economists look at all these numbers, do they all see the same numbers, or is there room for interpretation here in the way that you understand what the numbers say?
Well, you have to look at the numbers and you have to see what makes sense and what doesn't, assuming you don't have an agenda. And I think that's extremely important. Now, let's look at beyond the average, because don't look at the average. So what we did, we look at the quantiles, wage increase by quintile. Lower 20, 20 to 40. And we know that all the increase, most of the increase in vacancy rates is among low-paid individuals. That's where the vacancy increases. And people say, where is everybody? And people say they're all home watching Netflix. They're not. They're actually in the market. Something big is happening. So where have we seen the most significant increase? Because Economics 101 tells you, if you have shortage of something, the price or the relative price of this something will go up.
Yep.
Namely, the relative price of low-wage individuals should go up higher, stronger than other categories. And it's not happening. We have seen some increase in the second quintile, which is about average wage of $22 per hour. That's the most significant increase, but it's not enough. It should be double. So something is happening here. The market is not clearing. Economics 101 is not working. The question is why?
What's the answer?
Well, if you ask small businesses that employ many of those low-wage individuals, what they're telling us two things. One is that minimum wage went up in 2018. We simply don't have the margins. That's one thing. The other is they're telling us, economics like yourself, are telling us that a recession is coming. I'm not going to increase wages just before a recession, so I'm going to wait. That's, I think, what's happening. The market is not clearing. The market is telling you, pay more to get the people, and they're not, at least not yet.
Armin, it makes me want to come back to this notion of interpreting the numbers, whether interpretation is as important. And in this regard, I get how the charts can say the same thing, even though they look different. I get that now. But I hear you saying wages have been stagnant over the last many years, and I see Mikhail from University of Waterloo saying, doesn't look stagnant to me, looks pretty good to me. So you both can't be right there unless there's different interpretations on this stuff. Is that what's happening?
I'm sorry if I gave the impression that I said that wages were stagnant in the last 20 years. They were stagnant in the 80s and the 90s. They did start growing after the world entered a super commodity cycle and China came on stream as the low-wage factory of the world. Canada really was the cart that got pulled by China's ox. And we did really well because of that. Lots more jobs in lots of sectors, including high-paid mining jobs, high-paid exports to the United States that also did well. So we did really well from 1998 to 2008. A blip in 2008 because of the global financial crisis. And then instead of it being commodity driven, we saw very low interest rates drive a housing/finance boom for jobs as well as growth in Canada. Until the pandemic, that's what was pulling our economy along, was finance and housing. As you all know, that is not the sector you want driving the economy. It's a disaster for basic costs of living. But so I don't want to give the sense that we have had stagnant wages in the last 20 years, but I do want to give the sense that growth has been pretty steady, notwithstanding exactly what Ben was talking about. The lowest quintile, the lowest 20% of workers, did see some major increases for a while as minimum wages were raised before the pandemic hit. We've seen this huge thing that Kayleigh's been talking about, this enormous kind of discombobulation of the composition of the labor market, which shoves wages up and then down. And don't forget, these measures are always year over year. So the reason why you saw a dip is not that you're giving money back, but compared to the composition of the labor market in 2020, 2021 had a lot more low-wage workers. So it looked like on average, the market was giving money back. It wasn't. We were just adding a different type of worker. So the composition of work is incredibly important to Benjamin's point. And here, Kayleigh made a really good point earlier too, that some of the wage increases is coming from people getting more for doing the same thing. And some of it is coming from people moving along to a different job. And there we are starting to see not a whole lot of difference in the composition of the labor market. It's bigger, but it's not a lot different than it was pre-pandemic because people want to go out and party. They want to go to bars and restaurants. They want to go out and travel. And those sectors are slower to hire back people because there is a lot of tightness in the labor market. But to Benjamin's point, you know, when you ask for a new worker, you have to raise the bidding price. And so it's these openings that are huge in sectors like bars and restaurants and in travel that are really driving prices up in the private sector. In the public sector, there's a lid on it. There's a lid on healthcare, which is the biggest vacancies that we're seeing right now by public policy design. So you're getting a lot of different things happening. You really do need to look at it industry by industry. Wages aren't stagnant. Opening bids for vacancies are higher than they used to be. Wages did go up by 5% in December of 2022. As others have said, it's still behind inflation. The question is, will they keep escalating as collective agreements come open for rebidding? That's really something to keep your eye on.
Benjamin, you wanted to respond.
Yes, two things. First of all, when it comes to labor, I think that we have to realize that in a normal recession, let's assume that you were working for, let's say, Air Canada. You lost your job. You went on employment insurance for 6 months. The recession is over. You go back to Air Canada, and everything is okay. Today, after 3 years, you moved on. You are in a totally different industry. We have a measure looking at people moving from one industry to another. It's record high. So if you're Air Canada, you basically have to start fresh, and that's why it takes so long. That's one thing. The other is that we discuss wages now for 20 minutes. We haven't mentioned the word productivity even once.
Oh, I got that chart coming up right here.
And that's what I'm perfect. So productivity is the key. Productivity is the key. Because if I give you a 10% wage increase and you're 10% more productive, that's not inflationary.
Right.
And the Bank of Canada is not worried about it. So we need to see productivity rising. And in this sense, I'm actually very optimistic. I think that we're going to see a wave of increased productivity over the next 10 years. I hope I'm right on this one. We can discuss it later if you wish.
Okay, well, let's put this next chart up. Sheldon, if you would, middle of page 3, because we actually had a conversation on this program about this very issue recently, and someone made the point that there has been a decoupling between wages and productivity, which was of concern. And yet this chart, and again, for those listening on podcast, I'll describe it. We've got labor productivity versus real compensation. And, you would want, as Benjamin just described, you would want wages to go up as productivity goes up. And that looks like what's happening here. I mean, it looks like the lines are together. In 2020, there's a big spike in total compensation, but there's a big spike in productivity as well. It comes down as COVID ensues, but basically the lines mirror one another. So, Kaylee, isn't that the way it's supposed to be?
It's a great question. I think what we need to do is look back quite a bit farther than just to 2018 to tell the full story of how wages decoupled from productivity. That actually happened way back in the 70s. There was a time when wages and productivity kind of moved in tandem along an index, and that changed back in the 70s. If we were to add in total compensation, that would include benefits and other things, we would see it moved a little bit more closely together. But we know that people have become more productive. Would we like that to have come along a little bit faster? Yes. But our wages haven't kept up. So one of the questions is, if we're asking people to work harder, work alongside technology, and they're not being paid for the new skills that they have and the more effort they're putting into their job, then that's a real problem.
Okay, Trevin, do you want to weigh in on this issue of whether wages and productivity have gone in sync or not?
I think that they're still in sync and that they have been historically as well. I mean, if we're looking at the numbers from around 2000 to 2019, let's forget about the outlier of the pandemic for a second. Real wages and productivity were generally in line. You know, real wages were about 0.75% each increase each year. Productivity was about 0.77%. About 40% of the gains from productivity ended up going to labor during that period as well. Certainly, you know, during the pandemic, we saw quite a few things change. You know, at the beginning of the pandemic, when we saw some, you know, that spike as well. Certainly some of that can be with a number of people leaving the labor force. That might have been in lower skilled occupations, and that might have an impact on the productivity in the labor force as well. But when you look at the general trend line, it generally remains in line. And actually what might be of larger concern is that because productivity remains so tied to real wages, is the productivity challenges that we have in Canada. You know, Canada's productivity has been relatively anemic for the past many years, and going forward, you know, the OECD says that it's going to remain so, and we're going to be near the bottom of OECD countries too, and that might actually be one of the downward pressures on wages going forward.
Well, we hear this all the time, that we're not as productive as we need to be. So, Benjamin, tell me this. How are productivity numbers captured in the first place?
That's a very good question. And you know what? The people that put those numbers together will not bet their paycheck how accurate those numbers are. Let's face it. It's a very difficult thing to measure. They measure it as a residual of something, the residual of something. It's so complicated. I don't buy those numbers. I don't think they're correct. But you know what? That's the only thing that we have to work with, so we work with it. Now, I think that clearly, when it comes to productivity, we are lagging the US because they measure the same way and they are better than us. So something is happening here. However, as I said, I'm beginning to be more constructive on productivity for a few reasons. Because I think that until now, let's face it, until COVID, profitability for corporations was easy. There was globalization, there was just-in-time inventories, and labor was available and cheap. Now everything is upside down. You have deglobalization, you have just-in-case inventories, and labor is not available. The bargaining power of labor is rising, I hope. Wages are starting to rise, which means that companies are starting to see downward pressure on their profit margins. What do? You pay or you replace labor with capital. You replace labor with capital. That's productivity. I believe that productivity will be rising over the next 10 years, basically what we saw during the 1990s. I hope that's the case, because clearly productivity is not rising fast enough.
Did I hear you say that you hope wages go up? You're a bank economist who said you hope wages go up?
Absolutely. I think that wages should go up, and they should go up, especially for lower wage individuals where the vacancies are rising.
Okay. Armin, the reason I'm asking about how productivity numbers get captured is because, and look, I'll only talk about what I know, which is this place here. I know, for example, that when somebody is sick, is away on long-term disability or something like that, or if somebody, for whatever reason, isn't into work someday, the rest of us sort of pick up the slack, right? There's not necessarily a body that is hired to come in and fill the place of those who are producing shows. And as a result, those of us who are producing shows produce more of them for the same wages. Now, to me, that's an increase in productivity, right? We're putting out more shows with the same number of people. Does that get captured in the numbers? I don't know that it does.
I want to echo what Ben said, which is our measure of productivity sucks and always has sucked. And I think the only way you can talk about your sector, Steve, is to have less sucky ways of measuring productivity. But
is that a technical term, Armin?
Yeah.
Yeah.
But to Ben's point, you can see that we have a different trajectory than the United States using exactly the same measure. And that's something that a lot of mainstream economists have complained about for decades. We've, thrown the book at trying to improve productivity, tax cuts, regulatory cuts, wage suppression. We've introduced temporary foreign workers. That's an aspect of why the very bottom of the labor market, the very bottom 20%, may not be seeing any pay raises because we're pouring low wage workers into the market through immigration and through temporary foreign workers. We brought in 1.2 million people in 2021, a pandemic year. What do you think is going to happen when you're flooding the market with potentially low paid workers? So yeah, we didn't talk about the supply side, and that is actually what the Bank of Canada is saying we should do, is flood the market with more immigration so we can keep a lid on wage growth. Terrific. But to Ben's point about productivity, what the pandemic also taught us was the role of digital technologies. Not everybody does remote work. Work from home was available for 40% of the workforce in the middle of the pandemic. That meant the majority of the people that were still working had to be in a place to do their work. Now it's at below 20%. But some of those 20% are some of the highest paid people. So if you can do the work from Barrie, Ontario, why not from Bangladesh? I think we have begun to see the impact of digital technologies on decoupling tasks from jobs and doing more just-in-time platform, work of auditors, engineers, architects, people doing paralegal searching for deeds. All of these things can be done from someplace else with the exact same skills, but at much lower cost, whether that's within Canada or outside of Canada. That will raise productivity. I'm not sure it's so great for the workers themselves because these are the people that pay the bills for our healthcare system, for example, or in our education system. And the other part I'll say about productivity is if you're looking to goose profitability, you just sit back and wait, because you know who's got healthcare in their crosshairs is private equity and investors. And I'm not sure we want greater productivity and profitability in the healthcare sector. That's what we're seeing play out in real time in Ontario. And so the holy grail of higher productivity depends very much on what sector you're talking about and how are you getting it. And what does that mean for the average worker who is going to end up supporting the largest cohort ever of old people, young people, and people too sick to work? It's the smallest working age cohort. You do want wages to go up, not just to goose productivity and technological change, but to pay the bills for what we need to survive.
Benjamin.
Yes, I think that we have to put things in perspective, and I think that I would like to share one number with you. We created about 600,000 new jobs since the beginning of COVID, up and down, about 600,000. All of them, basically all of them, 100%, were university-educated individuals, all of them. That's amazing. And I think that COVID opened up the market for educated people with skills. Before COVID, we had a mismatch in the labor market. We had people without jobs, jobs without people. We had university-educated people serving coffee. We all know the story. Now, you are in Toronto, you have skills, you cannot find a job. In Toronto, you can find it in Alberta, in BC, in New York, Zooming, virtual. So COVID opened up the job market for educated people. In this way, I think that COVID is an event as opposed to just a condition. It's something that really led to a significant change in the way we think about the labor market. Now, this means that the income inequality is widening. People with education getting the ability to work everywhere, while people that are here in the services sector cannot do that. That's a major issue.
All right, so Trevin, help me understand that then. On the one hand, if we've got 600,000 new jobs since COVID-19 hit, and they're post-secondary educated people, that sounds like a good news story. But if the wage gap is widening, if the opportunity gap is widening, that sure doesn't. What do we make of all this?
Absolutely, and a lot of it depends on the sectors and the occupations that we're talking about as well. We kind of did a deep dive into one of the biggest questions that we get asked from businesses and other organizations: where did the workers go during the pandemic? We saw quite a few Canadians actually end up leaving the labor force and retiring, perhaps earlier than they had initially planned at the beginning of the pandemic. We actually saw an increase in the labor force participation rate of core age Canadians, people 25 to 54, but it didn't offset the amount of people that retired. And then third, we saw this mismatch taking place in the labor labor market between the skills that are being demanded and the skills that are being supplied when it comes to people coming out of university and educational systems as well. And so some of this is what's kind of putting the upward pressure on wages that we've seen during the pandemic, particularly during the past couple of years as well, which is having an impact. But it's also kind of straddled between different occupations. So a number of people that left the labor force at the beginning of the pandemic were in, lower wage, lower skilled occupations, and might have taken the opportunity to reskill or upskill into new positions going forward as well. And so this is kind of the new dynamic that we're seeing taking place in the economy.
Okay, Kaylee, this feels like the right question for a labor economist, okay?
Right.
Post-secondary, we've heard talk now about education and about the gap in education here. All of the jobs seem to be going to people who've got better as opposed to worse education since COVID-19 hit. If there is a skills gap between what workers have and what employers want, whose job is it to fix that gap?
If
Go.
we could answer that question in one sentence, I think it's the responsibility of all different sectors to work together to solve this problem. And what we've seen in the past is workers, individuals, have been asked to fill the whole gap themselves. We have the highest, most educated workforce in the world. And we're seeing more people get jobs in their fields potentially, so that's great. At the same time, we're going to be going through a major transition. We're seeing the transition right now in the auto sector. We're moving to electric vehicles, for example. And that means that a lot of people need to be retrained. Now, are we going to send them back to university in order to get this new skill? Or are employers who have the workforce right there and ready going to provide the training that is necessary to bring them up to speed to be able to produce this new car? So that's kind of at the micro level. We've seen investment in training on the job decline quite a bit in the last few decades, and that's one area where the responsibility has actually been abdicated. I also hear people say all the time that workers aren't capable of learning, or older people. It's so hard for older people to learn. It's something that comes up in panels and discussions all the time that I totally disagree with. People are capable of learning. Where you are on the scale of what you know and what you have to learn might differ dramatically, and also how long you've been out of school and the last time you learned a new skill might differ dramatically. So there's a whole kind of conveyor belt that you need to figure out where you're jumping onto, and it's our responsibility as policymakers, as government, as employers, to get together and actually design a program that helps people get on the treadmill so that they can learn these new skills.
Okay, fast follow-up in our last 30 seconds here. If you've been, let's say, working on the assembly line in Windsor for 30 years, building internal combustion cars, and suddenly you got to build EV cars, do you think the employer has the capability of teaching the employee, and does the employee have the skill to learn how to build a whole new kind of car at the age of 57, let's say?
100% yes. 100% yes. And this transition certainly is happening in electric vehicles, but we also see it in sectors, in every sector, whether you're being asked to work alongside new technology. Biometrics in airports is something that we're seeing come online quite a bit more now. One thing that we talk about at work all the time is kind of our tagline when we're thinking about new technology. How do you get the best of technology when you're at work and avoid the worst of technology when you're at work? Because the implementation of something new that will enhance productivity can go really poorly. And then we see all of the increase go to profit, and that's when inequality is rising.
If you figure that out, let us know.
No problem.
That's a key question. No problem. Thanks to our guests in Ottawa, Armin Yalnizyan and Trevin Stratton, and to our guests here in the Big Smoke, Benjamin Tal, Kaylee Thiessen. Great to have all of you on TVO tonight. Many thanks.
Thank you.
The Agenda with Steve Paikin is made possible through generous philanthropic contributions from viewers like you. Thank you for supporting TVO's journalism.